Okay, so imagine this. You've just bought this, like, perfect commercial building, right?
Yeah.
But then after you close, bam, leaky roof, maybe some environmental issue you never saw coming. Total nightmare, right?
It's definitely a scenario you want to avoid. That's why due diligence is so important. It's like detective work, but for real estate. You're uncovering these hidden clues that can make or break your investment.
And we've got a mountain of materials here on the subject. Legal advice, checklists, even stories from investors who've learned these lessons the hard way.
Yeah, we've got years of experience condensed right here in this stack of information.
So what's our mission for this deep dive then? What are we hoping to accomplish?
Our goal is to help you understand the most crucial aspects of due diligence for your next commercial real estate purchase. And it's not just for seasoned pros either.
Right, because anyone can benefit from this knowledge. Right?
Exactly. Whether you're just starting out or you've been doing this for years, understanding due diligence can save you time, money, and a lot of unnecessary stress.
So you said it's like detective work. What makes due diligence so important in this whole process?
Well, it's not just about avoiding those bad deals, although that's obviously a big part of it. Due diligence is also about uncovering those hidden profit gems that can turn a good deal into a fantastic one.
So it's about finding those things that the seller maybe didn't mention.
Exactly. And it's about verifying everything you've been told. Think of due diligence as gaining confidence as a buyer. It's knowing that you won't be hit with any nasty surprises after you've closed the deal.
So instead of just trusting the seller, you're basically double-checking everything. Is there a certain point where due diligence is most crucial?
You actually want to start your due diligence even before you sign that purchase agreement. This gives you the chance to really scrutinize those leases and dig into the details.
So what are some of the red flags we should be looking out for in a lease?
Hidden cancellation clauses are a big one. You don't want to be caught off guard if a major tenant suddenly decides to back out. Another tricky thing to watch for is operating expense exclusions. You know, those sneaky little things hidden in the fine print.
Right, because those can really impact your bottom line if you're not careful.
Absolutely.
Okay, so it's not just the rent amount. It's about understanding all those details. What about service contracts for the building? Should we be looking at those too?
Definitely. Those are crucial. You need to find out if they're cancelable and if they automatically renew. Sometimes you can get locked into these really unfavorable terms for years without even realizing it.
So we've done our homework before signing anything. What happens once that agreement is signed? What's next?
That's when you bring in the third-party reports. Think of these as your allies in uncovering any hidden issues or maybe even opportunities you missed.
So things like environmental assessments or property condition reports, right?
Exactly. You might even want to consider a seismic risk evaluation, depending on the location.
Okay, so we're getting an objective view of the property. But what about getting the inside scoop from the people who know the building best? The tenants.
Tenant interviews can be incredibly valuable. They can give you insights you just wouldn't get anywhere else. Like, how responsive is the landlord? Are there any unresolved disputes, maybe even hidden perks the seller didn't mention?
Because they could also mention problems the seller might have downplayed, like those recurring maintenance issues.
Right. And speaking of people who really know the building, don't forget about the building engineer and the property manager.
But that's a great point. They must have a ton of information.
They do, but remember, they work for the seller.
Right, which means they might not be so quick to point out any problems.
Exactly. That's where your detective skills come in. You need to ask the right questions and be persistent to get the information you need.
Okay, we've looked at the documents, we've seen the reports, we've talked to the tenants. Now let's get to the juicy part. Those hidden pitfalls that could make or break the deal. What should we be watching out for?
One of the biggest ones is building code violations. Don't just take the seller's word for it.
Right.
A trip to the local building and safety department can uncover a whole lot more than a seller might want you to know.
I remember reading a story about an investor who found some major structural issues that the seller tried to cover up. It's a good reminder not to skip this step.
Absolutely. Another common pitfall is square footage discrepancies. Has the building actually been measured accurately?
Because if it's overstated, you could be paying for space that doesn't actually exist. That could be a huge financial hit.
Exactly. But on the flip side, you might find that there's more square footage than you thought, which could be a hidden profit opportunity.
And I guess that's why it's crucial to actually see every part of the property during those inspections.
Precisely. Don't let the seller limit your access. You need to see every nook and cranny, every single unit. Who knows? You might even find things like mold, water damage, or even missing suites.
Wait, missing suites, really?
Oh, it happens more often than you think. Maybe a suite was absorbed by adjacent units, and the rent roll wasn't updated. That's why you can't just take the seller's word for it.
Wow, this is really starting to feel like a detective story.
Yeah.
What about energy efficiency? Is that something we should be thinking about as a potential pitfall or maybe an opportunity?
Energy audits can be incredibly helpful. They can pinpoint those hidden energy hogs in the building.
Oh, so you can find ways to cut costs and potentially increase the property's value.
Exactly. Due diligence helps you see the property's potential, both the good and the bad.
So we've uncovered all these potential pitfalls. Now we need to document everything, right? The materials we have really emphasize the importance of a clear paper trail.
Documentation is your best defense if anything goes wrong down the road. Emails are especially crucial because they create a time-stamped record. A record of every question asked and answer received.
So if there are any disputes later on, you've got proof. What about organization? What's the best way to keep track of all this information during due diligence?
It's all about creating a system. Whether it's a spreadsheet or a project management tool, find something that works for you and track every piece of communication. That way, nothing slips through the cracks.
Okay, we've got our documentation in order. Now it's time to talk about negotiation. How can we use all of this information to get the best possible deal?
Well, knowing the property's strengths and weaknesses gives you a massive advantage in negotiations. You can use those due diligence findings to justify asking for a price reduction or even other concessions from the seller.
So it's not just about pointing out the problems, it's about using that knowledge to create a win-win situation.
Exactly. And remember, you always have the power to walk away if the seller isn't willing to negotiate fairly.
Knowing your walkaway point is so crucial. It gives you the confidence to stand your ground.
Absolutely.
We've crunched the numbers, negotiated the deal. What's next in this real estate adventure?
It's time to tackle the final hurdles, the appraisal and the closing statement. Don't assume that everything will automatically go smoothly at this stage.
Why? What could go wrong at this point?
Well, for example, you can't just assume that the appraiser will automatically arrive at the right value for the property.
So we need to be prepared to justify the price we're getting.
Exactly. And then there's the closing statement. This is where many buyers tend to lose focus, but it's absolutely crucial to scrutinize every single line item to avoid overpaying.
So even though it feels like the finish line is in sight, we can't let our guard down just yet.
Absolutely not. There could be hidden fees or credits from the seller that could easily slip through the cracks if you're not paying close attention.
This has been incredibly insightful. What would you say is the most important takeaway for our listeners when it comes to due diligence?
Think of thorough due diligence as having X-ray vision for your real estate investments. It lets you see those hidden details that can either save you a fortune or help you make a fortune.
It's not just about dodging those bad deals. It's about uncovering those hidden opportunities and making informed decisions.
Exactly. So here's a question for you, the listener. What questions would you ask the seller or the tenants to uncover those crucial bits of information during your next commercial real estate purchase?
That's a great question to think about. The more you know about a property, the better equipped you are to make that smart, informed decision.
Exactly. So keep those questions coming. Welcome back to our deep dive. We've covered the basics of due diligence, but now let's get into the nitty-gritty of different property types.
Yeah, because each one comes with its own set of challenges and opportunities.
Absolutely.
Let's start with industrial properties.
Yeah.
What are some things our listeners should be thinking about when they're looking at these?
Well, industrial, it's all about functionality, right? You need to think like a tenant. So ask yourself, are the utilities strong enough to handle a big manufacturing operation? Can the building itself take the weight of heavy machinery or tons of inventory?
So you're not just looking at the space, you're thinking about how it will be used.
Right.
What else is specific to industrial properties that we need to consider?
Access is huge. Can those big trucks easily get in and out? Is there enough room for them to maneuver, load, and unload?
I guess you got to think like a truck driver.
Exactly. Put yourself in their shoes. Then there's zoning. What are the restrictions on the types of businesses allowed? And any environmental issues that could impact future use, those are important too.
It sounds like there's a lot of specialized knowledge needed for industrial due diligence.
There is. And that's where a local broker who specializes in industrial properties can be a goldmine of information. They'll understand the local market, the competition, all those nuances.
Makes sense. Okay, let's switch gears and talk about retail properties. This is a whole different animal, especially with the rise of online shopping.
You're telling me. Retail due diligence requires understanding consumer trends, the competition, and one of the biggest factors, the tenant mix.
Why is that so crucial?
Because the right mix creates that synergy that brings in customers.
Mhm.
You want a variety of businesses that complement each other, something for everyone.
So it's not just filling any empty space. It's about creating a shopping experience that makes people want to come back.
Right. And think about visibility. Can people see the property from the street? Is there enough parking? Can customers get in and out easily? Those are all deal breakers.
Convenience is key.
Absolutely. Now, retail leases, those often have these things called percentage rent clauses.
Okay.
So the rent is tied to how much the tenant sells. You got to understand how that works to figure out your potential income.
Sounds like some serious financial analysis is needed.
You bet. You'll need to project income, expenses, even future costs to see if it's really profitable.
And with retail changing so fast, what are some trends that could affect a property's value down the road?
Well, online shopping is the big one, but then you've got the demand for those unique experiences, focus on local and sustainable businesses, and tech is playing a bigger role too.
So retail due diligence means keeping up with the times.
You got it. Now, multifamily residential, many listeners might already be familiar with this, but there are still some pitfalls to watch out for.
Like what? What should we be paying extra attention to?
Local rental laws and regulations, those can change from one city to the next, and they cover everything from security deposits to evictions.
It's like a legal maze.
It can be. That's why having a good real estate attorney is so crucial, someone who can guide you through all that.
Definitely. Anything else that's important when looking at multifamily?
You want to check the property's physical condition, especially in older buildings. The roof, plumbing, electrical, HVAC, those can be major expenses if they need fixing.
Oh, yeah. Those can add up quickly. And what about the tenants? Is it important to know who's living there?
Absolutely. Find out how long they typically stay, what their demographics are. Are there lots of noise complaints or high turnover?
So we're not just investing in bricks and mortar, we're investing in a community.
Exactly. And these days, those amenities play a big role too. Laundry, fitness centers, maybe even dog parks.
Yeah, those can make a property much more attractive to potential renters.
Right. And that means you can charge higher rents, reduce vacancies, which is what it's all about.
We've covered industrial, retail, and multifamily. What's next?
Let's talk about those office buildings. They're facing their own unique challenges in this new world of work.
Especially with all the remote work and flexible schedules.
Exactly. So when you're evaluating an office building, think technology.
Right.
Can it keep up with the demands of today's businesses? You got to check the internet, the data cabling, all that.
So it's not just square footage, it's bandwidth now.
You got it. And then there's security. Data breaches and cyber attacks are a big concern, so that's another thing to look at closely.
Right, got to keep all that information safe. How about energy efficiency? Is that a factor for office buildings too?
Big time. Energy costs can eat into a tenant's profits, so those energy-efficient features are a big selling point.
So not only is it good for the planet, but it can also save those tenants money.
Exactly. And just like with multifamily, accessibility and amenities are important.
Making sure it's easy for everyone to get around and having those perks that make it a nice place to work.
Precisely. Think fitness centers, conference rooms, maybe even an on-site cafe. All those things can justify higher rents.
We've covered a lot of ground here, but I'm sure there's even more to learn about due diligence.
You bet. In our final segment, we'll dive into some advanced techniques like financial statement analysis, negotiation strategies, and how to navigate the closing process.
Sounds like we're about to level up our due diligence game. Welcome back. We've covered the basics of due diligence and dove into the unique aspects of different property types. Now, let's unlock some advanced techniques.
We're going to explore financial statement analysis, negotiation tactics, and navigating the closing process.
All right, let's start with those financial statements. Sounds a little intimidating, but I guess it's key to understanding a property's financial health. Right.
Absolutely. Financial statements are like a property's vital signs. They tell a story about its income, expenses, and profitability. By analyzing them, you can spot red flags, find hidden opportunities, really make informed investment decisions.
So where do we even begin? What should we be looking for when we crack open those statements?
The income statement is a good place to start. It shows you the revenue and expenses, usually over a year. Look for trends in rental income, vacancy rates, and operating expenses.
What kind of trends should set off alarm bells?
Keep an eye out for any weird fluctuations, like if the rental income suddenly drops or the operating expenses spike, that could mean trouble.
So it's not just the numbers themselves, it's about understanding what those numbers are telling us. What about the balance sheet? What can we learn from that?
The balance sheet gives you a snapshot of the property's assets, liabilities, and equity. Pay close attention to debt levels, cash flow, and overall stability.
So we can see how financially sound the property is. And of course, we can't forget about the cash flow statement.
Right. That one tracks the cash coming in and going out. It helps you understand how the property generates and uses its money, which is super important for its long-term viability.
So by looking at all three statements, we get a complete picture of how the property is doing financially. And this isn't just a one-time thing, right?
Nope, not at all. Review them regularly, especially during due diligence, to see if anything's changed or if any new trends pop up.
Okay, we've tackled the numbers. Let's move on to negotiation. I imagine this is where all our due diligence work really pays off.
Absolutely. Knowing the property's ins and outs gives you the upper hand in negotiations.
So how do we translate all that knowledge into actual negotiating power? What are some good strategies to keep in mind?
Be prepared. Before you even start, know your walkaway point, the price or terms you're not willing to budge on. And don't be afraid to actually walk away if the deal isn't right.
Knowing your worth, right?
Exactly. Also, be respectful but firm. Don't be afraid to ask for concessions based on your findings.
So it's a balance between being assertive and maintaining a good relationship.
Right. And lastly, get creative. Sometimes the best solutions come from thinking outside the box. Don't be afraid to explore different options and see what works.
Negotiation is an art. Okay, we've analyzed the numbers, we've negotiated the deal. What's the last hurdle we need to clear?
Closing. This is where it all comes together.
Why is it so important to stay focused during closing? What could go wrong?
Stay organized. Keep track of all those documents, deadlines, emails. A checklist can really help make sure nothing falls through the cracks.
Organization is key.
Absolutely. And carefully review those closing documents. Every single detail matters, from the purchase price to the closing costs. Don't hesitate to ask questions if something doesn't seem right.
Having a good real estate attorney is a must at this stage.
Absolutely. They can catch anything that might be off and protect your interests.
And finally, communication is key, right? Make sure you're talking to everyone involved, the lender, your attorney, the seller, the title company.
Keep everyone in the loop to ensure a smooth closing.
This has been an amazing journey into the world of due diligence. Any final words of wisdom for our listeners?
Due diligence is a commitment, a dedication to knowledge. Embrace the process, ask tough questions, and never stop learning.
It's a mindset.
Exactly. Thorough due diligence is an investment in your peace of mind and your success in real estate.
Thank you for joining us for this deep dive into due diligence. We hope you've gained some valuable insights to take your real estate game to the next level. Happy investing, everyone!